Good morning, ladies and gentlemen, and welcome to the ME Group International PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the team from ME Group International. Vlad, good morning, sir.
Good morning, and thank you all for joining us. My name is Vladimir Krasnyansky. I'm head of IR and UK Commercial Operations, and alongside me is the CFO, Stéphane Gibon.
Good morning.
So today we report on ME Group's interim results for the 6 months ended 30th of April 2024. We will start the presentation with highlights from H1. We'll then briefly remind you about ME Group, who we are and what we do, and then Stéphane will talk you through the financial performance and I'll talk you through the business review. Lastly, we will conclude with a summary of the first half performance and the outlook for the remainder of the year. So, turning to the first half highlights. It's been a positive first half for the group with good financial and strategic progress, which put us on track for another record performance in FY24. Our laundry business, WashMe, is our fastest growing business area, and it delivered a strong performance with a record 420 new machines installed and double-digit revenue growth. Our Photo.me business performance and demand for Photo ID was robust, and we have continued to strengthen our partnerships with site owners in high footfall locations. Cash generation from operations increased by 25.5%, and we have a strong balance sheet that allows for organic growth, supporting investment in our growth strategy and delivering shareholder returns. The group remains focused on profitability, returns, and cash generation, with these metrics being key performance indicators. So, ME Group at a glance. For those who don't know ME Group, I'm going to provide a brief overview of our business model and key strengths. So, we are an automated service company that operates a diverse range of machines across 18 countries globally. We have two core business areas, which are our photo booth business and our laundry business. And we have other business areas which we classify as being ancillary. What ties together all of our business lines is that our engineers service all machine types. We often have multiple product types on the same locations. So, for example, at a Morrisons supermarket, you'll find our photo booths, kids' rides, printing kiosks, and Revolution laundrettes. And we operate the same revenue share commercial model across our product types. So, in terms of our business model and key strengths, we have a number of key advantages in the markets we operate in. The first is that we have very predictable and stable cash flows, which enables us to invest and launch new products and geographical areas. We have industry-leading technological innovations and a proven track record of launching new products. For example, the WashMe division was launched around 2010 and now represents over 40% of group EBITDA. We also have long-term relationships with key site partners in all the countries we operate in. And finally, one of our key USPs as a business is our engineering network. This allows us to launch new products in all markets that we operate in very rapidly. So I'll now hand you over to Stéphane to talk through the first half financial performance.
Thank you, Vlad. We are pleased to report positive trading momentum driven by growth across our core business areas, primarily WashMe and also Photo.me. Reported revenue increased by nearly 5% to 150.4 million from 143.8 million in H1 2023. Throughout the first half, we experienced significant foreign exchange headwinds, which saw the Japanese yen decline by 15% against sterling and the euro decline by 2.2%. When excluding the FX impact, revenue was up 8.6%. EBITDA improved by 11% and it increased by almost 15% excluding FX impact. The EBITDA margin improved to 34% compared with 32% in H1 2023. Profit before tax was up 10% to 30 million and was up more than 13% excluding FX impact. Profit before tax margin was 20%. As a result of this foreign exchange headwind during the first half, we are exploring options to mitigate our exposure to currency risks. The group remains highly cash generative, with cash generated from operations up 13.3%. Excluding FX impact, cash generated from operations was up 19%. The movement in gross cash is primarily due to loan repayments totaling 14.9 million in H1 2024. We repaid a similar amount in H1 last year. Net cash reduced, reflecting the ongoing investment to deliver on our growth strategy and payment of shareholder dividends. We enter the second half of the year in a strong financial positions, with the means to fund the group's exciting growth plans. Diluted earnings per share increased by almost 12% to 5.97 pence per share, up nearly 17% excluding FX impact. This performance has enabled the board to declare a 16.2% increase in the interim dividend to 3.45 pence per share, a record for the group, which will return a total of 13 million to our shareholders. Our policy is to pay annual dividends over 55% of annual profits after tax, subject to capital requirements. This bridge shows a more detailed breakdown of the revenue performance. Our WashMe business saw the largest revenue gain, contributing an additional 6.3 million compared to the prior year. This growth was driven by demand for our laundry services and the ongoing expansion of our Revolution network. Photo.me contributed an additional 2 million in revenue compared to the prior year, reflecting robust demand for official photo ID services and an increasing in the number of photo booths in Japan. While our Print.me, Film.me, and other vending equipment businesses saw slight declines, we consider these ancillary parts of the company. When excluding the impact of FX headwinds, revenue increased to 156 million at constant FX rate. This slide illustrates the profit before tax bridge, moving from 27.2 million in H1 2023 to 30 million in H1 2024. The PBT benefit from increased revenue was 6.5 million due to the increased volumes, and the contribution from consumable spare parts provided a 2.1 million boost to PBT. Commission paid was 2.4 million higher, primarily due to the removal of the machines following withdrawal from a low-margin contract. Profitability is a key indicator for the group, and the board expects to deliver record profitability against in FY 2024. The group's net cash position at the start of the financial year was 33.9 million. The group is highly cash generative, with 41.7 million generated from operations, and a further 1 million was generated from sales of machines. Estate and infrastructure investment, tax, share buyback program, and interest and finance amounted to a combined cash deduction of 53.5 million. Subsequently, closing net cash as of 30 April 2024 was 21.7 million. This is a new slide giving more detail on how we have deployed CapEx. As you can see from the graph, CapEx increased significantly by 26.6%, with Photo.me CapEx increased by an additional 7.7 million, reflecting the expanded rollout of next generation photo booths. Wash.ME CapEx also increased by 1.2 million, with the investment almost entirely related to the production and installation costs associated with deploying Revolution machines. CapEx on the remaining businesses is slightly down as our current growth strategy focuses on our investment on our core and most profitable business areas. In continental Europe alone, we committed 19.5 million of CapEx, where the majority of our investments was focused. I will now hand over to Vlad to take you through the performance by geographic region.
Thank you, Stéphane. So, Continental Europe is our largest and most profitable geographical area, and we have continued to diversify the portfolio, with laundry now contributing 32% of vending revenue in the region. Revenue for Continental Europe increased by 5.2% to £98.3 million, with operating profit stable at £21 million. Wash.ME performed particularly strongly in Europe, with vending revenue up more than 17%, with the expansion of laundry operations continuing at pace and a further 282 machines installed in the period. This has brought the total number of laundry machines in operation across Continental Europe to 4,492. Photo.ME revenue was also up 1.9%, with demand remaining robust. We are continuing to work closely with our established partners and key customer accounts, which include major supermarket groups such as Lidl and Carrefour, to grow the vending estate across Europe. Operating profit was flat at £21 million, but up 1.9% excluding the FX impact. In the UK and Republic of Ireland, new laundry accounts for 55% of vending revenue. Revenue increased by 1.9%, primarily driven by the group's exit from a photo booth contract in the UK in 2022. However, the nature of this contract means that this had a limited input on profit generation. Wash.ME continues to perform strongly in the UK and Ireland, with vending revenue up more than 16%, and 141 Revolution laundry units were installed in the period, a record for the UK and Ireland, which increases the total number of machines by almost 24%. The growth in operating profit was extremely strong, with operating profit up nearly 29%, reflecting cost efficiencies and a withdrawal from the previously mentioned contract in the UK. So, revenue in Asia increased by 9% to £26.4 million, and this performance was mainly driven by the photo booth business, following the Fujifilm acquisition in 2023, which saw an increase of 3,611 photo booths in Japan. We also expanded our freshly squeezed orange juice vending operations in Asia, with 475 machines in operation to date, 404 machines in Japan, and 71 machines in Australia. Operating profit was flat at £3.3 million, and the board expects growth to accelerate in the second half of the year as the photo booth acquisition synergies are realised, machines are being relocated, and operations are being optimised. I'll now talk through our business areas. Demand for photo ID remains robust, with revenue up 2.4% and up 7.5% excluding FX impact. Activity levels at our photo booths have remained robust through Q1 and Q2, and we have seen a strong performance in Q3. The average revenue per machine in H1 decreased by 8.4%, and excluding FX impact, it declined by 3.4%. This can be attributed to the acquisition of the photo booth estate in Japan, which had lower revenues than our global estate. CapEx increased significantly to £9 million as we continue to invest in the rollout of next generation photo booths. EBITDA is also only marginally down, however, when excluding FX impact, it was up 2.7%, and EBITDA margin remained robust at 34%. We expect to invest between £5 and £6 million in H2 to support our plan to install 2,000 to 2,500 next generation machines by the end of 2024. We plan to have installed a total of 8,000 by the end of 2025. Wash.ME is the group's fastest growing business area by number of units and EBITDA. Total Wash.ME revenue grew by nearly 17% to £44.1 million, up nearly 19% excluding FX impact. And total Wash.ME EBITDA increased by 15% and contributed to 41% of group EBITDA. This was driven by strong demand and a record number of Revolution Laundry units deployed at 1,078 units. The group remains focused on expanding its Revolution Laundry machine estate with a record 420 Revolution machines installed across our key geographies at an average rate of 70 per month. Revolution revenue was up 18% and Revolution CapEx increased to £12 million. We are on track to install a record number of machines in FY24 at an installation rate of 80 to 90 per month in the second half. The Laundry Services consumer app, launched in the summer of 2023, has achieved over 21,000 downloads on Android and iOS platforms across Europe, with a 75% conversion rate to registered users. We believe our consumer app will enhance the customer experience, reward loyal customers, and drive repeat sales going forwards through our targeted marketing campaigns. Our Wash.ME business remains a key growth driver for the group. So, Print.ME is an ancillary business area with operations primarily focused in France, the UK, and Switzerland. Revenue decreased by 10.3%, excluding FX impact. Revenue was down 8.6%. A total of 240 machines were relocated to a new contract with leading French multinational retail chain Fnac. EBITDA remains stable at £2 million. CapEx is expected to increase in the second half of the year, with 500 new machines installations planned. In recent years, we have integrated our printing capabilities across our photo booth estate, and a number of machines, particularly next-generation photo booths, now offer multi-functionality for consumers, including mobile to print. Our food vending equipment operations are a small and profitable part of the group. Total revenue in the period was £5 million, which contributed to 3.3% of group revenue. We installed an additional 100 fresh juice machines in Japan, bringing our total units in operation across Japan to 475. While this business area remains attractive, it has developed more slowly post-pandemic than anticipated. In May, the group sold its non-core Sompa business, which specialised in the sale of fresh fruit juice equipment, for a total cash consideration of €4.6 million to reinvest in core photo booths and laundry operations. Other vending equipment comprises of two business areas and accounts for a small portion of group revenue and profit. Therefore, it's not reported individually as a business area. We will continue to operate other vending units where profitable. These machines are typically located in high footfall locations alongside the group's principal activities, benefiting from existing site owner relationships and operating synergies. Currently, we have 6,114 machines in operation across 12 countries. So to conclude, we are pleased to have made good progress during the first half of FY24, and we have enhanced returns to our shareholders with a record interim dividend announced. We are confident the group is well positioned to build on the record performance delivered last year. Looking ahead, the second half of the year is typically seasonally the group's strongest trading period. Our Wash.ME operations are growing rapidly, and we're on track to deliver a record number of installations in the second half of the year. Photo.ME has seen strong demand from Q2, which has continued in the year to date. We have a strong balance sheet to support organic growth as we continue to capitalise on significant market opportunities for photo booth and laundry services. R&D and technological innovation is ongoing, with new services in the pipeline which will continue to diversify our portfolio and product offering, such as automatic key cutting machines. ME Group is a dominant player and market leader in the growing automated machines market, and the group remains focused on profitability, returns, and cash generation, with these metrics being key performance indicators. The board remains confident that we will deliver another year of record profitability in line with current market expectations. Thank you very much for joining us for the presentation, and we'll now take some questions after a brief moment where we can review the questions and select them.
Perfect. Vlad, Stefan, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Vlad, Stefan, as you can see, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. And guys, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Great. So we'll now start to answer the questions. So the first one is, how will the reduction in manufacturing costs affect future profitability?
Yeah, I take this question also. For sure, this the reduction cost the reduction of the cost is critical for us, and you have seen that in the RNS that we have done extremely good progress in R&D for the reduction cost. At first, for the photo booth, where we have decreased the revenue by 28%. Mostly it is due to the fact that we, as you know, we are planning an extremely huge program of machine for the next generation photo booth, and this will of course mechanically decrease the cost of the machine. The second point, in the laundry business, on the laundry side, we have decreased the cost of 13%. And this is mostly due to progress that we have done in the R&D. So this is extremely critical for our business. You can imagine because it allows us to maybe sometimes to go in additional sites where maybe at first glance the profitability is not exactly the same.
Yeah, absolutely. Just to add to that, I do want to correct Stefan. Our photo booths are not going to decrease revenue by 28%. The cost is the cost is decreased by 28%. What I would say is it has a major impact on profitability. As you've heard through our presentation, profitability is our key metric that we judge all new sites by, and by reducing down the cost of our two core areas, being photo booths and Revolution laundrettes, it will immediately make those business lines more profitable, and also, as Stefan says, allow us to go into locations where previously the upfront investment may have been too significant versus what the revenue expectations were going to be. So the second question is, Sempa was an expensive failure that failed very quickly. Why did we misjudge this, and what have we learned? Well, what I would say is I think that is not the way that we see it internally. We think that it's a great thing that the group continues to experiment with different business lines and different innovations. And whilst Sempa did not fit into our overall model after a few years of integration, we would say that we moved on from this strategic choice very quickly, and also there was no material write-down on that.
So at first there was no material write-down, absolutely clear. But also we have during the year we have made profit, and at the end it was not a failure, it was a success. But for sure the situation is now different, and we have seen that Sempa is decreasing his own revenue. We have decided to stop it because once again it was not our core business.
Yeah, and we have, as a company, we have a responsibility to our shareholders to focus on the areas where we see the fastest growth and the most profitable business areas. So, again, we absolutely see future growth of the company being in photo booths and particularly Revolution laundrette, and we're very proud to be delivering on that growth. So the next question is, are there any new territories that you plan to enter? There are lots of territories that we are absolutely planning to enter. In terms of medium to long term, For the Revolution laundrette in particular, you have to look at what is the largest laundrette market globally, and that is the US. So certainly, from a group perspective, long-term vision is to expand into lots of different territories, but the US is a natural one that would appear to be very interesting. So we are continually looking to launch new countries. Of course, we want to do so in a sustainable fashion and make sure that we have an operating network that can service those machines, but we're absolutely looking at new territories. So the next question is great news on the 16% interim dividend increase to 3.45p. Given the policy of paying 1/3 annual dividend as an interim, this suggests a potential total dividend of 10.35p. Does this mean that we can expect annual dividends to be significantly above the 55% of profit after tax threshold this year? Or is there upside potential to the current EPS forecast?
No, not really. So far, the idea is always to respect the policy of the group, so it's 65% of the net profit. But we have decided to pay a little bit more dividend in the interim dividend. That's it.
So what consumer trends are you seeing in the laundry services market, and how do these support your long-term growth plans? So that's a great question. We see continued uplift in consumer use of our machines. It's for a couple of different reasons, but one interesting bit of research that we did recently is that we see that only 40% of our users in a small-scale study were ex-laundrette users. So we're seeing a lot of new usage of our machines and new customer usage of people who weren't previously using laundrettes. There's a couple of reasons behind that. The primary one is convenience. So for a lot of our consumers, they can do a week's worth of laundry at our machines in around 45 minutes. That is hugely convenient for a lot of our customers. And the best part is, while they're waiting for their laundry to be done, the machine locks and we send them a text 5 minutes before the laundry is the cycle's about to end. So that means that they'll often go and use the supermarket and do their weekly shop while they're doing their entire week's worth of laundry. So we're seeing really strong positive customer demand for our services, particularly Revolution Laundry. And as we deploy more machines, we'll capture more and more customers. So what are the hurdles to implementing more than 1,000 Revolution units per year? In terms of bottlenecks, which is, I guess, what the question is, it's certainly not from the production standpoint. So we have very flexible production, so we can ramp up the number of machines that are being produced. One of the bottlenecks we would say is that we have a very particular commercial model, and we want to make sure that we grow sustainably. So what's really important for us is that every machine that we place and install, we feel very confident that it will generate the required revenues and required profitability for those sites. So it means that we are very, should we say, picky in regards to where we install machines. So we're constantly, throughout all the countries we're operating in, our commercial teams are driving around the countries and finding the best locations for our Revolution Laundry units. So the next question is, what internal audit is carried out and what are the key internal audit findings, both positive and negative?
So, as you know, there was, you may know it, there was 3 audits already done so far, and on the operational side. Processes, yes, it's extremely important for us, especially for the countries that are far from for example, let's talk about Asia and so on, to know if the group processes are followed. So it was the main mission of the internal auditor at first, and also on the operational side, because it completes the Mazars audit.
Great. So the next question is, what is driving the step up in new laundry units in H2? So one of the reasons for that is just the seasonal nature of our installations. So for the first half of the year, I think I mentioned it in the presentation, but in December, a lot of our major retailers and a lot of our major partnerships are very reticent to allow new machine installations. They don't want any building works on their sites before their very busy seasonal periods. So December tends to be a lighter installation month for us, also alongside the fact there are lots of bank holidays and periods where people are off. So the second half of the year doesn't have any of those periods, and we see very strong demand from our site partners to increase the number of Revolution Laundry units on their estate, and we expect a very strong H2 in terms of Revolution installations. So we have time for one last question. So the question is, could you talk us through the decision to sell the property in Grenoble? Also, what is the long-term view on investment into Energy Observer Developments, SAS?
So regarding the decision to sell the property in Grenoble was done, I would say, was taken around a few months ago. We have decided at the end to sell it because we wanted to stay finally in the manufacture in Grenoble as it was. We have decided to modernize it, and in this case, it was not a good idea to remove all the staff to the new site. That's why we have decided to sell it. So we have so far two promises. It seems to be well advanced, and we think that we may have sold it before the end of October.
Perfect. So that concludes the Q&A section. Just as a last word, we want to thank you all for your attendance to this webinar, especially after a disappointing Sunday for many UK investors. We're very proud of our performance in the first half of the year, and we will look to continue to deliver both growth and profitability in the second half of the year. So thank you all very much again, and we look forward to speaking to you soon.
Perfect. Vlad, Stefan, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Me Group International PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.